This lesson will focus on Chapter 2, which reintroduces students to financial statements. Now, I use the term reintroduce because you should have already been introduced to the term financial statements and how to put them together in your Accounting 1 and Accounting 2 classes. However, for the purpose of this class, Finance, we're going to focus on the review of financial statements and on how they're used by analysts both within and external analysts to make sound financial decisions regarding a company. Now, there are four main financial statements. The balance sheet and the income statement will be focused on in this lecture. The remaining two financial statements, which are the statement of retained earnings and the statement of cash flow, are not going to be touched upon. The purpose of this lesson is to focus on the interrelationship, or how the balance sheet and the income statement work together, and the process by which these statements can be used to project a firm's future cash flows. The balance sheet is probably the most important financial statement. It represents the assets owned by the company and the claims against those assets, which are liabilities, and the actual ownership stake that a company has in those assets, which is owner's equity or just equity. The balance sheet is described by what's known as the accounting equation or the accounting identity, which is that assets equal liabilities plus owner's equity. So let's take an example, a home. If you were putting together your personal balance sheet, you may own a home that's worth $200,000. That is your assets worth, $200,000. So you have a $200,000 home. You may have a home loan of $150,000. The difference, or equity, is going to be the difference between the $200,000 value and the $150,000 that you owe, or you could rewrite this equation to say that equity equals 200 minus 150. Let's take a look at a sample balance sheet. Batista Products, which is a fictional company, is showing their balance sheet as of December 31st, 2011 and December 31st, 2010. Now, one important characteristic to note about a balance sheet is it shows the assets, liabilities, and equity as of a certain date, or as on a certain date. So when looking at this balance sheet for Batista Products, it is going to be the amount of assets, the claims against those assets or liabilities, and ownership or equity on the 31st of December in 2010 and 2011. And many times, companies or analysts will compare the prior year to the current year so that they could see the change, or what's known as the variance between years. So let's take a more in-depth view of Batista Products. In a balance sheet, the assets are broken up between current assets and longer-term assets. A current asset is described as an asset that is most liquid, and liquidity refers to how fast an asset can be converted to cash. You can't get much more liquid than cash itself, so it's listed as the first current asset. You can see that Batista Products had cash on hand of $1.6 billion, Now, this is in thousands listed here, but you also have to see or make note of the reference in the balance sheet. So it's dollars and millions. So whatever number you see here, you'd have to add 6 zeros to the end of it, which is 9 places, which means this is actually $1 billion. So even though this $1.6 billion is a whole lot of money to you and I, it is less than what the company had on hand last year. And you can see that they changed or they decreased $65 billion or $65 million year over year. Short-term investments are those investments that are going to mature in less than a year. So a short-term investment is anything that has a maturity date that is less than 1 year of time. $1.17 billion in 2011, significantly lower than the $3.1 billion in 2010. Accounts receivable has gone up, which can be a good thing for a company. It means they are making more sales. It may also mean that people are not paying their debts off at a fast clip as fast of a clip as they did in prior years. And inventories on hand have changed 233 million year over year, which means they've made more products, but they have yet to sell those products. And then you can see that you have other total assets or other current assets, which could be anything that can be defined or not defined within these 4 line items. And then you have a line item for your total current assets, which is basically just the sum of all the numbers in the column above that line. And you can see from year to year, it has decreased by $1.3 billion, primarily driven by this decrease in short-term investments. Following total current assets, you have your long-term assets, which is really your plant, equipment, and buildings. These are things that are durable and can be held in the long term. You can see that Batista Products has made a significant investment in their plant, property, and equipment to the tune of about $1 billion. And then their other long-term assets increased by 167. Total assets is going to be a sum of total current assets and these line items that follow below it. Now, looking at the liabilities of the company, we can see that the liabilities are anything that is held or claims against the company or claims against the company's assets. Accounts payable refers to the bills a company has to pay. Sorry about that. These bills can be salaries, they could be utility bills, they could be insurance. You could see that this negative number means that their accounts payable has gone down. So even though this is a negative number, this is a favorable variance, meaning that a negative variance on an expense or something that is owed is good for the company. Short-term debt or debt that is going to expire in less than 1 year has gone down significantly, about $2 billion, which told me that the company had a lot of short-term debt in 2010. This short-term debt may have been used to finance some of this plant and equipment. And then other current liabilities. Total current liabilities, just like total current assets, sums up the numbers in the column above. Then below that they have long-term debt, or loans outstanding that are going to mature in greater than 1 year, and then other long-term liabilities. And then they add up total liabilities, which is a sum of total current liabilities, long-term debt, and long-term liabilities. Now, the difference between assets and liabilities is owner's equity or equity, and that's broken up between the amount of stock that's outstanding and the retained earnings or the profits that are held by a company. And if you add liabilities and owner's equity together, you'll get a total number. That total number should match this total number, and it does. And the balance sheet gets its name because both sides, assets and liabilities plus equity, have to equal or balance. So in summary, the balance sheet has 5 main sections. The cash account, and when looking at Batista products, we want to know where the $65 million decline came from. Working capital accounts, which are current assets minus current liabilities. This is the money coming into the company minus the money that's going to be going out of the company in the relative short term. Long-term asset accounts, plant, equipment, land, and buildings. And these long-term assets are carried at its net or depreciable value, which is the gross value or what you paid, all the cost of what you paid for it, minus any accumulated depreciation, which, as you know, is the runoff expense of that company or of that long-term asset against the products and the revenue that it's creating. The fourth part is the long-term liabilities, and the fifth is the ownership accounts. The income statement, unlike the balance sheet, does not show the health of a company at a specific date, but shows how the company has performed within a given point of time up to a certain point of date. And what an income statement shows is the revenues and expenses by a firm over a prior period. That typical period is usually a month, a quarter, which is 3 months, or a year. And there are 2 items or 2 calculations that are very important to the income statement. One is net income, which is revenues minus expenses. And that includes all expenses, both cash and non-cash, which include appreciation and depreciation, taxes and interest. And then we have EBIT, which stands for earnings before interest and taxes. And EBIT is calculated by taking your revenue number and only subtracting out your operating expenses. Your operating expenses are the expenses directly related to running the company. They do not include your interest on your debt, does not include any taxes paid, and normally it would not include any amortization or amort/depreciation. Excuse my writing. Commonly, you would see this as EBITDA, earnings before interest, taxes, amortization/depreciation. But for our intensive purposes, we could just look at this part of the calculation. So let's take a look at Batista Products. For their most current year, which ended on December 31st, 2011, again, this is stated in millions of dollars. So they had revenue of $35,750,000,000. This is a lot of money. Their cost of goods sold was roughly $14 billion. Now, if you take the cost of goods sold and use that as the numerator and take your revenue and slide it under as your denominator, you will find what's known as your gross profit or your gross profit margin. And a good gross profit margin for a company should be anywhere between 30 and 50%. And what that states is that how much money those products are really throwing off when you account for the purchase or production of those products towards the rest of your expenses. So as you see, as you can work down the company's assets depreciated, your selling, general, and administrative expenses. This is your overhead. This is your salaries. This is your payroll taxes on salaries. This is your benefits. This is your rent or leases. This is your electricity bill, your water bills, your telephone bills. All gets rolled up into what's known as SG&A. And then your other expenses gives an operating income of about $7 billion. Now, if you take operating income and use it as a numerator, and again use your gross revenue or sales as a denominator, you'll come up with a ratio that's known as operating margin. You added some other income, which is normally income from assets not related to operations, and then you get your EBIT, which is the sum of these two numbers. Subtract your interest expense out, you get your taxable income. You make an assumption for your taxes. Corporate tax rate is about 38%. You take that product, you subtract it out, you get your net income. This number here, EPS at 3.73, refers to earnings per share. Their earnings per share was $3.73 for every share of stock outstanding. And that is found by just taking the net income and dividing it by the number of shares. Now, something you need to keep in mind. Net income is not the same as cash flow, because net income includes depreciation / amortization, which is a non-cash item. Net income is different than cash flow. When we look at our income statement, we can see that the firm earned a net income of $5,642 million, or $5.6 billion. However, cash decreased by $65 million. And there are three reasons. One is the accrual accounting, i.e. the booking of expenses when they're incurred and not when they're paid. So if a bill, the December 2011 electric bill came in and is put into the system in December but not paid until January, those expenses will hit in December, although cash will go out in January, following January. The non-cash expense items, like the previously mentioned depreciation, and the preference to classify interest expense as part of financial cash flow. If you remember from your cash flow statement, in cash flow statement analysis or lesson in accounting, cash flows are broken up into three sections. One is cash from operations. The second is the cash from investment activities, which is the purchase of capital stock like plant and equipment. And the third is cash flow from financing, money that's coming in terms of loans and stock sales. Now, in finance or in accounting, investment relates to capital equipment, plant, land, and buildings. And finance refers to the methods in which those capital expenses are purchased, i.e. through loans or through selling part of your company. So please keep that in mind as we move forward. The third and fourth cash flow statements will give the definition, but we won't spend too much time on it. The cash flow identity and the statement of cash flows. The cash flow identity states that the cash flow on the left-hand side of the balance sheet is equal to the cash flow on the right-hand side of the balance sheet, which basically says the cash from assets is equal to the cash to creditors plus the cash to owners. Again, both sides need to equal. They need to balance. Figure 2.5 diagrams or outlines the cash flow identity and its components. And we could take a few minutes here to leave this up so you could look through it and take some notes. So feel free to work your way through and pause if you want to take notes. But since we're not going to be focusing on the cash flow statement moving forward, this is a little additional information just for your knowledge base. That concludes the lecture on the reintroduction to financial statements. This will directly lead into a second lecture on how to use financial statements to calculate financial ratios, which then could be used to compare one firm in an industry versus another firm in an industry.